What's going on, Savvy family? Welcome back to the channel. Kellen here, and in today's video I have 7 investing mistakes that you must avoid at all costs. I should have listened to my own advice because I just recently lost $2,000 in the stock market. My wife is not happy. So if you are a beginner investor, you are in the right spot. I'm going to share these costly mistakes that you're going to avoid and prevent yourself from being in the doghouse with your spouse. So let's jump right into it. All right, number 7 is thinking short term. When it comes to investing, especially in the stock market, you want to have a long-term game plan. You want to have a long-term horizon that you are investing in. You never want to try to get a get-rich-quick scheme. If you try to do that and you're thinking short term, how you can double your money in a week, in a month, you're gonna end up broke. You're gonna end up making stupid decisions, emotional decisions that are going to cost you a lot of money. You have to have a long-term investing mindset. You're gonna put your money into the market. You're gonna let it sit for 3, 5, 10 years, a couple decades to save for retirement and to make your money work for you and to use that compound interest and the appreciation that you can get over the long term. All right, number 6 is paying high fees on your investments. So whether you are part of your Works 401k plan, a mutual fund, broad index funds, individual stocks, you want to know what your fees are because they can really take a good portion of your investment portfolio if you're not paying attention to them. So we recommend broad index funds. We are obsessed with Vanguard's VTSAX, which is basically a broad index fund for most of the companies in the United States. So you're very diversified. The expense ratio is 0.04, so it's next to nothing to be a part of it. And an index fund basically tries to match the averages of the market versus a mutual fund, which is an actively engaged fund. They're actively trying to beat the market. So there's a lot of more fees involved with that. There's more people that are involved with mutual funds to try to beat the market. And most of the time they don't have on average fees between 1% to 2%. So I put together a little example here of what the difference could be investing in index funds versus mutual funds. So if you invested $500 a month for 30 years, a mutual fund at 2%, $500 a month for 30 years, you would end up with $1,683,201. If you used a broad index fund with a lower fee, you're gonna end up with $3,159,470. So almost double your money. You can obviously tell the difference. The fees that are associated with your investment accounts make a huge difference, so make sure you are investing wisely and not getting screwed by your fees. All right, number 5 is trying to time the market. This is one that caught me. This is just one of the mistakes I made. I made a bunch of these that you'll hear later on in the video. But trying to time the market, trying to understand when it's gonna go up, when it's gonna go down. If you ask any expert, there's no such thing as timing the market, especially Warren Buffett. He will probably slap you across the face if you try to tell him that you can time the market. The market, there's so many variables that go into the economy, into individual stocks, that there's absolutely no way to predict when it's gonna go up, when it's gonna go down. I believe it or not, I think less than 1% of people are capable of day trading and trying to time the market, and it's pretty much a gamble at that point when you're trying to day trade and time the market. So just like in this last year, 2020, if you were to try to time the market and pull your money out when it was shooting down and trying to catch the rise, you could have missed 40% gains this year. Absolutely unheard of gains, historical year in the stock market. Things are extremely way up, especially for what's been going on. Pulling your money in and out is just an awful, awful strategy. Again, you want to invest in the long term. This is what caught me, and I will explain it in the next couple mistakes here. All right, the 4th mistake when it comes to investing is chasing past performance. It's trying to find those stocks that are on a huge uptick and get on them and ride the wave up even higher. Or looking at how the market did last year versus how it's gonna do this year. You really have to take it with a grain of salt. Historically, the stock market's always gonna go up over the long term, but trying to predict it short term like this, or trying to ride waves in and out is definitely a bad move. So on my screen here, I got my Robinhood account up. See if it focuses. We've got about $20,000 invested in the account. We like to only invest about 10% of our overall portfolio into individual stocks. For most people, individual stocks is not a good decision. You really want to invest in index funds and set it and forget it. But we like the approach of high risk, high reward. So we do individual stocks. And one of the things that really caught me and made me lose the money, the mistake I made, was looking at Tesla. I hate you, Tesla. Jumping on it when people were talking about it, and the day that it kind of sank more than 10%, I was an idiot and I pulled out our money. Because I thought it was going way lower and it ended up recovering the next day. So trying to look at past performance, trying to jump on it was a very, very stupid decision and one I regret. I regret it very much so. I regret it a ton. Just stupid investing mistake that I made. And these go into the other ones too. All right, so number 3 is not picking individual stocks. If you are like me, super emotional and like to be on top of things and control of things, investing in individual stocks is very difficult and hard to do because you have to invest in long term. You're not investing in the stock price currently, you're investing in the companies because you believe in them, you believe in their CEO's vision, their financials, that long term, over the next 3 to 5 years, they are going to outperform the market and they are going to outperform what they are currently doing. So there's a lot of growth involved. I've picked 10 businesses I believe in that are going to do really well over the next 3 to 5 years, and we plan on holding all of these positions in all of these stocks. So I don't need to go through them. If you want me to kind of go over that on a different video, I can certainly do that. Comment below if you want that. And let's move on to the next one here. All right, number 2 is contributing to your investment account, but not actually investing the money, having it just sit there in your account doing nothing for you. You need to go into your brokerage account, whether it's Vanguard or Robinhood or any other one that there is. There's tons of them out there, Schwab. You need to go into your account and actually invest into a index fund or a stock or whatever you plan on doing with your investments. If you just let it sit in your account, it's not gonna do anything for you. You need to actually go in and invest the money so it's working for you, earning those dividends, earning the appreciation that you want versus just it sitting there. A lot of people fall into that mistake. They'll contribute and they'll have thousands of dollars just sitting in their account thinking that it's invested, but it's literally sitting there losing money because of inflation. So do not make that mistake. That could be a huge mistake. All right, the number 1 mistake that you guys have all been waiting for is not investing early and often. This is by far the biggest mistake you can make, is waiting. Say you leave college, you're 20 years old, and you don't start contributing to your investments. You wait till you're 30, you wait until you pay off all of your debt. You're just waiting until you're making more money. Your lifestyle inflation is going up. The biggest mistake you can make is waiting to invest. Your biggest advantage in the stock market is your time. The sooner you start investing, the longer you are into the market and invested, your money has more time to grow and it exponentially grows. It's almost like a hockey stick chart where it's gonna really take off once you start getting more and more money into your investments. So you really wanna start contributing early and often as much as you can, at least 10% people. Just do it! If you can't come up with 10%, you need to sit down, you need to budget your money. We have a video on that we can link. You need to budget your money, you need to know where it's going, and you need to put it towards something that's going to help you in your financial future. So definitely start investing early, start investing often. It's never too late to start investing. If you're 40 years old, 30 years old, start now. You're just gonna have to contribute more to catch up to where you should be. So for example, say we have this person named Ashley and she's investing $500 a month for 40 years, and the other person is Amanda and she started investing $500 only for 10 years. Here's the difference. Ashley, who started way early, has a investment portfolio of $1,197,810 versus Amanda, who's only been investing for 10 years. Her investments are worth $6,907. Do you see the difference in that? Huge, 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 huge. Over $1 million difference because she started way later in life. So make sure that you are investing early and often. This is the number 1 mistake that you can make, is thinking that you can catch up. If you're not already started investing, go open up an account with Vanguard or Schwab with your company. If they do company match, you definitely need to start investing. Broad index funds, you can't go wrong. Let them ride, set it and forget it. Put your monthly contribution in, at least 10%. You want to be saving and investing of your money. Let it ride, let it grow, and you will grow your wealth just like that. So put your money to work instead of you always having to work for your money. There's no way to build wealth unless you're investing your money, unless you're putting it to work. You're literally just getting your paycheck and spending it. You're not gonna build wealth. You need to be investing your money. That's the video. Those are the mistakes you wanna avoid. Hopefully I showed you how to avoid those costly mistakes and not make a mistake like I did on picking individual stocks, trying to ride the wave. Speculative investing is stupid. Avoid it at all costs. Do not waste $2,000 like I did. It's a lesson learned. I am going to ride out my investments from here on out with Vanguard and my more diverse portfolio with Robinhood now. Hit the thumbs up if you found this helpful, and leave a comment below if you want some more investing videos. Give me some ideas. I can go over my portfolio, I can go over other one. Just so you know, subscribe. You don't want to miss any videos. All right, guys, get to investing, and I will catch you on the next one.